So, foreign central banks just dumped another $50 billion in US Treasury bonds. Let's see what this actually means for your savings. What happens when the countries that have been financing America's spending spree for decades suddenly decide they don't want to hold dollars anymore? And why are China, Japan, and other major holders quietly reducing their treasury positions while mainstream media tells you everything is fine? Today, we're breaking down why the dollar crisis isn't some conspiracy theory. It's a mathematical inevitability that will determine who preserves wealth and who watches their purchasing power evaporate. Section 1. The selling that nobody's talking about. Foreign holdings of US Treasury securities dropped by over $200 billion in the past year. Let me repeat that because it's crucial. The countries that have been bankrolling American deficit spending are reducing their positions at the fastest pace in decades. China's holdings are down to around $775 billion from over $1.3 trillion at the peak. Japan, traditionally the largest foreign holder, has been trimming positions as their own fiscal situation deteriorates. But here's what mainstream financial media completely missed. This isn't just portfolio rebalancing or technical adjustments. This represents a fundamental shift in how the world views US creditworthiness and the dollar's role as global reserve currency. When your biggest creditors start selling, that's not a coincidence. That's a vote of no confidence. The timeline has compressed dramatically. 5 years ago, talk of dollar collapse was relegated to gold bug forums and conspiracy websites. 3 years ago, mainstream economists started acknowledging concerns about fiscal sustainability. Last year, former Treasury secretaries began warning about challenges to dollar dominance. Now, central banks are acting on those concerns by reducing exposure. However, here's where it gets interesting for anyone trying to understand what's actually happening. The Federal Reserve's balance sheet still holds over $4.5 trillion in Treasury securities, down from the pandemic peak, but still historically enormous. So as foreign buyers exit, the Fed becomes buyer of last resort. Think about what that means. The government issues debt, and the Fed, another government entity, buys it. That's not a sustainable economic system. That's monetary fiction. Section 2. The math that doesn't work. Let's talk about the calculation that should terrify anyone holding significant dollar-denominated assets. US national debt now exceeds $36 trillion. Annual interest payments on that debt just crossed $1 trillion for the first time in history. Read that again. $1 trillion per year just in interest, not paying down principal, just servicing existing debt. But wait, it gets worse. The Congressional Budget Office projects deficits averaging $2 trillion annually for the foreseeable future. That means every year the government spends $2 trillion more than it collects in taxes. Where does that money come from? Borrowed. From whom? Increasingly, from the Federal Reserve, creating it from thin air because foreign buyers are backing away. Do the math. When you're adding $2 trillion in new debt annually while paying $1 trillion in interest on existing debt, you're looking at a debt spiral that has destroyed every currency throughout history. The only question isn't whether this ends badly, it's when and how badly. Compare this to household finances. If you earned $100,000 per year but spent $130,000, you'd need to borrow $100,000. $30,000 annually. Your debt would grow every year. Interest payments would consume increasing portions of your income. Eventually, no one would lend to you at reasonable rates, and you'd face bankruptcy. The US government faces the same math, just with more zeros. The point I'm making is this. Once debt reaches levels where interest payments consume significant portions of tax revenue, you're locked into a trap. You can't raise taxes enough without crushing the economy. You can't cut spending enough without political upheaval. Your only option becomes inflating away the debt by printing money. And that's exactly what's happening. Section 3. The BRICS alternative nobody wants to discuss. Now let's examine what mainstream economists dismiss as irrelevant. The BRICS nations building alternative payment systems. Brazil, Russia, India, China, and South Africa along with newly added members like Saudi Arabia and UAE, represent roughly 45% of global population and 35% of global GDP. And they're systematically reducing dollar dependence. China and Russia now settle significant bilateral trade in yuan and rubles, bypassing the dollar entirely. Saudi Arabia, after 50 years of exclusively pricing oil in dollars, now accepts yuan for Chinese oil purchases. The UAE has established yuan clearinghouses. India settles trade with multiple partners in rupees. This isn't theory, it's happening right now. This created artificial demand for dollars and Treasury bonds, allowing the US to run enormous deficits without immediate consequences. When that artificial demand disappears because countries have alternatives, the consequences arrive. Section 4. The interest rate trap. Here's what financial media won't tell you directly. The Federal Reserve faces an impossible situation. If they raise interest rates to defend the dollar and attract Treasury buyers, they crash the economy and make government debt service costs explode. If they keep rates low or cut them, they accelerate dollar weakness and inflation. Look at the recent data. The Fed held rates at 5.25 to 5.50% through 2024, the highest in over 20 years. What happened? Regional banks failed. Section 5. The inflation that's already here. Let me explain something that most people completely misunderstand about inflation. The official CPI numbers showing 3 to 4% inflation are statistical fiction. Real inflation, measured by what actually matters, food, energy, housing, healthcare, education, runs significantly higher for most Americans. The government changed inflation calculation methodology multiple times since the 1980s, each change conveniently reducing the reported number. Use the original calculation methods, and inflation over the past 4 years exceeds 25 to 30%. Your grocery bill knows this, your rent knows this, your health insurance knows this. Only the government statisticians pretend otherwise. What causes this inflation? Money printing. When the Fed created trillions of dollars during the pandemic, that money didn't disappear. It's circulating through the economy, chasing the same amount of goods and services, driving prices higher. The more Treasury debt the Fed monetizes, the more dollars exist, the less each dollar purchases. The insidious part is that inflation effectively defaults on government debt without formally defaulting. Borrow $1 trillion today. Pay it back in 10 years with dollars worth half as much, and you've defaulted on 50% of the real value. This is exactly what the government will do, what it must do, because the math allows no other option. Section 6. The assets that survive. So what does this mean for your investment strategy? Should you panic and buy gold? Not exactly. The dollar crisis creates both threats and opportunities, but only for those who position themselves correctly before the masses figure it out. If you're holding cash or long-term bonds, you're on the wrong side of this trade. Those assets will lose purchasing power as inflation accelerates and the dollar weakens. Bonds might maintain nominal value, but will be repaid in devalued currency. Cash will buy progressively less. The winning positions become clear once you understand the dynamics. Hard assets that can't be printed. Real estate in desirable locations. Commodities, precious metals. Productive assets generating cash flow. Quality businesses with pricing power that can raise prices faster than their costs increase. International diversification. Assets denominated in currencies of countries with better fiscal situations. Bitcoin and cryptocurrency represent another option, though with significantly more volatility. The core appeal is that, unlike fiat currencies, Bitcoin has a fixed supply cap. No government can print more Bitcoin to finance deficits. Whether that digital scarcity ultimately proves as valuable as physical scarcity from gold remains debated, but the logic is sound. For younger investors with decades ahead, this transformation represents a chance to position correctly for the biggest currency reset since World War II. The mistake is assuming the current system continues indefinitely. History shows monetary systems based on debt and money printing always end the same way. Section 7. The timeline. Nobody knows. Here's what separates people who see this coming from those who get blindsided. Understanding that unsustainable systems can persist far longer than logic suggests. The dollar has been finished, according to some analysts, for 20 years, yet it remains the dominant reserve currency. So when does the crisis actually arrive? The answer is gradually, then suddenly. Foreign central banks reduce holdings by small amounts quarterly. That's gradually. Then one day, a major holder announces a large sale, triggering other sellers, and suddenly Treasury auctions fail to find buyers at prevailing rates. That's suddenly. It could happen next month or 5 years from now. The mainstream narrative claims the dollar is fine because it remains the dominant reserve currency. But that's backward thinking applied to dynamic situations. The dollar dominates because it dominated, and systems have inertia. But like an avalanche, once movement starts, it accelerates. The dollar's share of global reserves has declined from 72% in 2000 to under 60% today. The trend is clear, even if the timing is uncertain. Look at historical precedents. The British pound dominated global trade for centuries, until suddenly it didn't. The transition from pound to dollar as primary reserve currency happened over roughly 30 years, accelerating dramatically during the World Wars. The dollar to whatever comes next transition might follow a similar timeline, though potentially compressed by modern communication and financial technology. Section 8. The reality most ignore. My hypothesis is this. Despite claims that American economic dominance and military power guarantee dollar supremacy indefinitely, the mathematical realities of debt, demographics, and deficits make significant dollar devaluation inevitable. You can't run trillion-dollar deficits forever without consequences. The alternative is that somehow the US government implements fiscal responsibility, cuts spending dramatically, raises taxes substantially, and pays down debt. Looking at the political environment, does anyone actually believe that's happening? Neither party shows any serious commitment to fiscal sustainability. Every election features competing promises to spend more on different priorities. But that assumes rational actors making difficult choices, which history suggests is optimistic. More likely, we'll see continued deficit spending, accelerating inflation, currency weakness disguised as necessary policy, and blame assigned to external factors rather than admitting the mathematical inevitability of the outcome. The people who thrive will be those who understood basic math, recognized that debt-based monetary systems have expiration dates, and positioned accordingly. The people who suffer will be those who assumed their dollars would always buy what they buy today. Their bonds would preserve purchasing power, and the government would somehow solve problems it created. The dollar crisis isn't coming. It's here. It's just not evenly distributed yet. Some people see it in grocery prices. Others see it in declining Treasury demand. Smart money sees it in the mathematical impossibility of the current trajectory continuing indefinitely. Which group do you want to be in? Call to action. Foreign central banks just dumped over $200 billion in US Treasury holdings, while the national debt exceeds $36 trillion, with interest payments crossing $1 trillion annually, creating mathematical conditions that have destroyed every fiat currency throughout history. The question is, will you recognize this as the early stages of a currency crisis and position yourself in hard assets, productive businesses, and international diversification? Or will you be among the millions who wake up one day to find their dollar-denominated savings bought half of what they used to? Drop your thoughts in the comments, and if you want analysis on the economic trends reshaping wealth before mainstream media figures it out, hit subscribe. See you in the next one.